Hi all, hope you are in a good health. My name is Astrid Tanggara. I am one of MBA candidate in IPMI International Business Class. I would like to share what I learned so far from corporate finance class by Professor Roy Sembel. Objective of the course is to give the student problem-solving skill in finance from the point of view of the management, internal and investor external. At the end of the course, the class are expected to be able to explain important financial management decision and interlinkage among them, apply financial management decision-making tools in analyzing financial decision problem, explore and evaluate opportunities to create financial value to firm and investor. Utilize logic of corporate finance to improve participants' decision in others' business-related situation. Demonstrate ability to discuss in a structured way hot issue that emerge in business or finance media. There are 8 topics related to corporate finance, which are financial management, time value of money, capital budgeting, investment strategy, capital structure, corporate restructuring, fraud management, dividend policy, and efficient market hypothesis. Let's go through one by one. Financial management. Financial management has 3 keywords. It's optimal orchestration of internal and external financial resources towards significant and sustainable value creation. There are several financial resources to be managed. Those elements should be managed to achieve goal of a firm, which is not profit, but value creation. When a firm trying to create a value, sometimes there is principal-agent problem happen. Principal-agent problem happen because there are 2 parties, the principal and the agent. From the point of view of the investor, they want to get the maximum benefit. However, from the management point of view, they want to work lightly, relaxed, but plenty of bonus and high salary. Those are the conflict of interest. Asymmetric information. Information is not balanced. Management knows more about the business because they run it day to day. Shareholder know less or know limited information about the company. Moral hazard is basically the management want to get the benefit for themselves. Consequences of asymmetric information and moral hazard is the management tends to report only the good things to the shareholders, so the shareholder think that the management is actually doing a good job. The solution is cannot be only one. It should be a comprehensive solution. It called the good corporate governance. Good corporate governance consists of 5 things. We call it tariffs. T for transparency, A for accountability, R for responsibility, I for independency, and F for fairness. In this value creation, we also learn about Ramcharan 5 business essential. Professor Ramcharan mentioned that there are 5 business essentials for all business holders. There are cash, profit margin, velocity, growth, and customer focus. We also learn about 4 cornerstones of corporate finance based on McKinsey. Professor Roy gave a good example of a golf stick illustration. A business value depends on who owns or manages the business. In the case of golf stick, it may be only an old stick if it's handled by a wrong person. But if it's handled by Tiger Woods, for example, it will be creating a value. Now we learn about time value of money. Time value of money is an important topic to be understood in investment. Time value of money can be applied in many ways in the daily lives. There are two concepts that apply for time value money. It's the present value and the future value. Present value is talking about $1 today is equal to how much in the future, while future value talking about $1 in the future equal how much today. The time value of money assume receiving $1 in the future in the interest we could have earned if we have received $1 sooner. If we measure this opportunity cost, we can translate $1 today into its equivalent in the future, or we call it compounding. Translate $1 in the future into its equivalent today, which means discounting. We also learn about rule of 72. Rule of 72 is calculating how much time do we need to double our money with a given of discount rate. The next we learn about capital budgeting. Capital budgeting is an investment planning process for a long-term asset. So it's not for a short-term asset. For example, if you buy a building, is it creating a value? Are we going to accept or reject the project? What's the purpose of capital budgeting? First is to calculate expected future cash flow. Second is to evaluate the project based on capital budgeting concept. And third is decide whether a project is good or it's bad and we should reject it. There are several methods to calculate capital budgeting. There's a payback period, NPV or net present value, IRR, and profitability index. Payback period, the weakness of payback period is actually it's quite subjective. It's determined only 3 years or 5 years. It depends, right? So, and also it's not considering the return of investment, not considering net present value. Net present value is the better way of capital budgeting because it's compare money you have to sacrifice today. Benefit the project of the cash flow, present value, compare with what you sacrifice today. Internal rate of return, percentage average return per period if you put money in the project versus if you put the money in the bank. If the IRR is bigger than the required rate of return, then you can accept the project. And lastly is the profitability index. When we evaluating the project, there are two projects that we can evaluate. They are mutually exclusive, meaning that we can only choose one from many projects that we receive. And the second one is independent, meaning that we can choose all the good projects. So with this capital budgeting method, we can evaluate which project is creating value, whether we want to accept it or we reject it. Next is after we learn about investment strategy, let's learn about security analysis. Security analysis consists of some analysis we should understand before investing. Fundamental analysis is focusing on intrinsic value of the company by examining macro and industry factors. Besides that, we need to understand if the company healthy or not by doing the rational analysis by DuPont analysis. Then all of these analyses we can complement it with technical analysis which can predict the movement of the price of the stock by learning the movement of the chart. At the end, we can decide when is the right time to buy, when is the right time to sell, and to hold, and whether this investment is for long-term or for short-term period. After we understand the investment strategy, we need to calculate the company intrinsic value. Investment is all about risk and return. It starts with identifying risk. There are two types of risk. Unsystematic risk is the company's specific risk, while systematic risk depends on the macroeconomy. Unsystematic risk can be minimized by doing diversification, while systematic risk is the market risk that cannot be eliminated. Systematic risk is also called beta. Beta indicates how volatile is the market. With diversification, we can select our portfolio with those with negative correlation, so the negative effect one and another can be cancelled, so we get basically a good result. This is why there is a say that don't put your egg in one basket. Next, we need to know how much is the required return of our investment. We can calculate with the cost of capital. Cost of capital can be calculated based on two ways: capital asset pricing model and cost of debt or WACC. Capital structure. What is capital? Capital is long-term sources of fund. It can be from debt or equity. What is the ideal debt to value of firm? Value of firm is the present value of future flow for capital holder. Capital holder consists of debt holder and shareholder. We learn about irrelevant capital structure by Modigliani Miller. If all factors are ideal, then it is irrelevant. But if we change one factor not being ideal, then we can see the impact of the firm value. For example, the tax. The higher debt, the higher will be the interest rate, the lower will be the tax. The higher the debt ratio, the higher the value of the company, tax shield of interest payment. However, if we keep increasing the debt ratio and reach 100%, obviously supplier will not comfortable. They worry you cannot pay. Customer also not comfortable. It will affect the service quality. And employee also feeling not comfortable if something happen in the future and the company will be jeopardy. EBIT will shrink, expected cost of finance distress, the value of the company will be decreased. So we call this the financial distress. Corporate structuring. In corporate structuring, we learn about how to overcome a financial distress in the company. There's a permanent solution, meaning that if it's liquidated, it will be stopped the company. If you try to delay, you can file for legal bankruptcy. If the problem temporary, for example, because of COVID, after the temporary problem solved, you can do the operation efficiency, for example. Asset, check the high asset, the high cost, and then we can sell. Financial restructuring, nego with your supplier, private one by one, or consolidated through PKPU on the court. We also learn about fraud risk management. In this topic, we learn about fraud triangle. There's a reason of someone doing fraud in the company. There is pressure, there's opportunity, and also rationalization. How to prevent fraud risk in the company? is by using whistleblower mechanism. We also learned that there is 4 types of incentive for people or employee: physically, monetary, physical, social, and moral. But monetary incentive cannot write off the rest 3. We discuss also whether greed is good. Actually, it's good in the lack of better word. If we cannot find a better word, it's good. Because if it's meaning that you are passionate to look forward to achieve something, is actually good. We also discuss about ethical versus legal. What are the activity that is ethical but is not illegal, and not ethical but it's legal. Next, we also learn about dividend policy. Should a company pay a dividend? Why should a company pay a dividend? There are some reasons why a company should pay dividend. First is tax. It's not for the company tax, but it's for the personal tax. Second is the principal agent. Too much cash flow, company report is the real one. Shareholder expectation create value by paying dividend consistently, not only once. Pay dividend consistently when the money is there, confident of the company will be there. Next, we learn about efficient market hypothesis. We learn about EMH, is the price reflect all available information from historical trading data, publicly available information, and private and public information. However, with this, all information is past or historical information. We don't know the new information and what will be the price movement in the future. That we call the random walk by Gordon Malkiel, who can predict the future. So meaning that all the information that we don't know in the future is a random walk. So is the market efficient? What will be the strategy for us? First is diversification. Second is don't try to time security price movement. Keep tax consideration in mind. Passive investing like index fund, dollar cost averaging. This ended the 8 weeks of the corporate finance class. I personally received a lot of knowledge and also wisdom. At the beginning of the class, our lecturer, Prof. Sembel, mentioned that it's okay to make a mistake as long as if you try harder. And by also from Confucius, we know that if we only hear, we will forget. If we only see, we remember. And if only we do it, we can understand. So hope you learned something from this video. Thank you for watching. And don't forget to click likes button. Have a blessed day.